Do we have quorum now? Good morning, everyone. It's 10 o'clock. My name is John Crocker, and I'm the chair of the Toronto Investment Board. The clerk has confirmed we have quorum, so I'd like to call the special meeting to order and welcome everyone. The meeting is being held using the City of Toronto's WebEx technology, with members and staff connecting via video conference or calling in. Because we're meeting remotely, we ask for your patience with any delays and technical issues. Members of the public can observe the meeting on YouTube. I'd like to request that staff keep their video turned off unless they need to speak or answer questions. This will make it easier for me as chair and for those watching on YouTube to observe members as they participate in the debate on each item and during votes. Also, I ask that all members and staff keep their microphones on mute unless you need to answer a question or speak. If any members do wish to speak on an item, please make sure your video is on and raise your hand or unmute your mic and indicate your intention to speak, and I will create a speakers list. When voting, I ask that members make sure your video is turned on and raise your hands to indicate your vote. Although we are in different locations and meeting remotely today, the committee would like to acknowledge that the land we are meeting on is the traditional territory of many nations, including the Mississaugas of the Credit, the Anishinaabe, the Chippewa, the Haudenosaunee, the Wendat peoples, and is now home to many diverse First Nations, Inuit, and Métis people. We also acknowledge that Toronto is covered by Treaty 13 with the Mississaugas of the Credit. At this point, are there any declarations of interest under the Municipal Conflict Interest Act? And if you have an interest, please raise your hand or unmute your mic. Seeing none. Are we okay? Yep, seeing none. The item for this special meeting is IB 6.1, enabling remote electronic participation in Toronto Investment Board meetings during an emergency. I think we've sent out the material. I've assumed everyone has read it, and the basic issue here is that in creating the Toronto Investment Board, City Council had never anticipated a COVID-19 kind of experience where we can't actually meet in public, so that in the last few months they've developed this mechanism where we can meet our needs to deal with the public and yet meet in a safe fashion. So I think it's pretty self-explanatory, but I'll ask at this point, are there any questions of the staff on this item? Seeing none, anybody wants to speak on the item? Could I have a motion to adopt the staff recommendation? Sharon? I have a motion from Sharon Ranson. All those in favor, raise your hands. Opposed? Motion carried, and this special meeting is now adjourned, and we will start the next meeting in about 2 minutes or so. Confirmed that we have quorum, so I'd like to call meeting number 7 to order and welcome everyone to the meeting. Good? Good to go? The meeting is being held using the City of Toronto's WebEx technology with members and staff connecting by video conference or calling in. Because we are meeting remotely, we ask for your patience with any delays, technical issues. Members of the public can observe the meeting on YouTube. I'd like to request that staff keep their video turned off unless they need to speak or answer questions. This will make it easier for me as chair and for those watching on YouTube to observe members as they participate in the debate on each item and during votes. I'd also like to ask all members and staff to keep their microphones on mute unless they need to answer a question or speak. If any members do wish to speak on an item, please make sure your video is on and raise your hand or unmute your mic and indicate your intention to speak, and I'll create a speakers list. When voting, I ask members to make sure your video is turned on and you raise your hand to indicate your vote. Although we are in different locations today and meeting remotely, the committee would like to acknowledge that the land we are meeting on is a traditional territory of many nations, including the Mississaugas of the Credit, the Anishinaabe, the Chippewa, the Haudenosaunee, the Wendat peoples, and is now home to many diverse First Nations, Inuit, and Métis people. We also acknowledge that Toronto is covered by Treaty 13 with the Mississaugas of the Credit. Before we start, I'd like to acknowledge a little belatedly, because of COVID-19, the reappointment of Pamela Steer, Mary Robinson, and Tanya Lay to the board, so well done, all of you. Unfortunately, Tanya Lay has subsequently, for a variety of reasons, resigned from the board effective June 5th. So on behalf of the board, I'd like to congratulate Mary, Pamela on their reappointments and thank Tanya for her service to the board. Starting off with, are there any declarations of interest under the Municipal Conflict of Interest Act? If you have an interest, please raise your hand or unmute your mic. Seeing none, may I have a motion to confirm the minutes of the Toronto Investment Board meeting of December 4th, 2019? That motion from Sharon Ranson. All those in favor? Opposed? Motion is carried. We have one item of new business to add to the agenda. It's a letter from City Council regarding the Toronto investment policy update. So could I have a motion to add this item as new business? Could somebody raise their hand? Mary, we'll put you on the minutes. All those in favor? Opposed? Carried. We'll hold this item down so the clerk can make the amendment public online before we consider it in further detail later during the meeting. I'll now proceed to consider the items on the agenda. The first item is IB 7.1, was enabling remote electronic participation in the Toronto Investment Board meetings during an emergency. This item was on the agenda since we've considered it at a special meeting just a few moments ago. May I have a motion to withdraw the item? Somebody raise their hand. Pamela. All those in favor? Opposed? Carried. Second item is presentations from investment managers. We have three presentations on this item. The first, I'd like to ask, apologies about my name pronunciation, Nadeem Riz, Senior Vice President and Lead Portfolio Manager, Global Equities, Barbara Sheehan, Vice President, Institutional Markets, and Sam Ohamu, Administrative Coordinator, Global Equity Team, and give their presentation and introduce Fiera Global Equity. Are they joining us now?
Yes, hello.
Is that you, Barbara?
It is indeed, Mr. Crocker.
I'd like to give my usual reminder. We've already bought your services, so you can refrain from lengthy marketing and just get into the meat of your presentation. Over to you.
Thank you very much. Just for the record, I'm Barbara Sheehan, Vice President, Institutional Markets at Fiera, and I'm joined by Nadeem Risk, Senior Vice President and the Lead Portfolio Manager on the Global Equity Strategy. which is one that we manage for you. And on page 2, please. Just a reminder, bearing in mind the chair's comments, Fiera is a global money management firm with approximately 160 billion in assets under management, headquartered in Montreal with close to 900 employees. On the institutional markets front, where the assets that we manage for the Toronto Investment Board are found, about 90 billion of the 160 billion represent institutional assets. And with that, I will turn it over to Nadeem Risk and ask him to proceed with the global equity review.
Thank you, Barbara. I'm guessing everybody can hear me okay?
Sounding good.
Okay, thank you, Mr. Chair. We can go to the next page. Just introducing the team quickly. So myself, Nadeem Risk, my last name is pretty easy to remember. You've officially hired a portfolio manager with the last name of Risk. We'll see if that's a good or bad thing. So far, it's been good on my side. Team is, you see here on page 4. We've been at Fiera for now 11, 12 years almost. We started the global equity strategy from scratch. We have had quite an extensive experience researching and managing global equities before. I myself am a graduate of McGill, and I worked for the pension, Canadian National Railway pension. This is where I started in the business. And a number of people on the team, including Andrew, have been working with me for now almost 16, 17 years. The team has been essentially the same since inception at Fiera 11 years ago. We've added some newer members like Ivana, Wen, and Iser, you see at the bottom, but we've only grown the team. We've had hardly any changes since the beginning. We all research global equities, so the mindset of the team is one of global, even though we do have 2 separate strategies underneath the global, which are US standalone and international standalone. The research is done globally, as well as the compensation is also based on total performance over long periods, and it's also measured globally as well. Moving on to the next page. Yeah, one more, please. Okay. So just quickly, in terms of the way we view the world, our investment philosophy is one of long-term. So we focus on finding, analyzing, understanding, and holding incredibly high-quality businesses. And once we find these businesses, we tend to hold on to them for incredibly long periods. The way we define quality is a business that has the ability to generate a high return on capital, but also has the potential to organically redeploy or reinvest capital at incrementally high returns. These businesses tend to be obviously special because they tend to dominate something specific. Some of them can be large, some of them can be small, so size is not a significant factor. The thing that they do really well is they specialize, and they're incredibly strong at producing a specific product or service for which the clients pay a decent margin to have. Obviously, these businesses have strong cash flow generation. They tend to have very strong balance sheets because they're so profitable, and they tend to be what we termed as long-term compounders, meaning they steadily compound attractive shareholder returns over extended periods. At the same time, they tend to preserve capital because in difficult periods, they tend to shine given how profitable and how well run they are. Also, the quality assessment that we look at extends beyond purely a financial metric. It also includes obviously operational excellence, but also corporate culture excellence. Being an investor who's interested in owning businesses versus owning stocks, and being an investor that holds on to positions for incredibly long periods, we're obviously incredibly sensitive to both corporate culture, corporate ethics, corporate governance. But more recently, we started being sensitive to environmental track records of companies, as well as social involvements with companies. Again, all of these factors come in incredibly naturally for us because we are invested in companies and we're not trading in and out of positions. Talking about investing for the long run, on average, we hold companies in the fund between 10 to 15 years. Some positions have been with us for over 15, so 20, 25 years is something that we've seen as well. But on average, which means on average, we, the turnover in the funds or the amount of change we make in the fund is typically below 10%. So in a concentrated fund like we are of 20 to 25 positions, expect 1, 2, or 3 changes a year, and in some years we might actually not have any changes in the strategy whatsoever. Okay, next page, please. In terms of ESG involvement, like I said, ESG comes to us very naturally because of the style of investing. In the past, and I'm talking in the last 20, 25 years, we've been incredibly involved on the G side mostly. To us, corporate governance, and I add to that, corporate culture is incredibly important because, again, we are invested in a business. And so to us, understanding a company's corporate governance and culture and understanding what goes on into proxy voting, etc., is incredibly important because it is part of investing. We have been very involved in the past in either asking for change, pushing for change, whenever we felt it was in the best interest of the long-term investors like us. I have personally read and signed, for example, every single proxy of every single company that we've ever owned for the last 25 years. And so, we do go through many details on that side. Like I said, more recently, we started getting more engaged from the same perspective. The idea here is that we always felt that a company that had incredibly clean corporate governance and ethical culture had a much higher chance of having clean financial statements and clean operations. From that perspective, we decided to include environmental and social aspects as well in a company because, again, we believe that it's in the best interest of the business long term to be both sensitive to its own environment, but also its own social environment and social fabric. And we are also engaged with certain companies when we feel that within a reasonable impact on the business, being sensitive to their own environmental needs and social needs are incredibly important. Next page, please. Yeah, thank you. Just quickly, in terms of structure for the portfolio construction, like I said, we tend to manage relatively concentrated funds. By virtue of how sensitive we are to quality, we effectively have to be concentrated. We have no choice. Picking the best of the best means that you have to only hold a handful of companies. We also are of strong belief that the diversification benefit happens in the first 15, 20, or 25 securities, and holding more than that comes at the expense of quality without any benefit from diversification anymore. Positions typically are initiated at a somewhat smaller size, about 2%, and they tend to be limited at 10. That's not necessarily always the case. We could go slightly over 10, but on average, that's mostly the case. Today, for example, our largest position is about 9.6, 9.7%, so slightly under 10%. The position size is a combination of both quality, confidence, the period of which we've owned that position. So the longer the period, the larger the position, which means the larger the confidence in that position, as well as the potential of that position to generate returns. We are always diversified in terms of sectors, so we require a minimum of 4 sector representation. Today we have a lot more than that. But again, we don't need to be in every single sector out there. What's really critical for us is to have or to own businesses that are very different from an end market, from a client, from a driver, from a product or service perspective. So we try not to hold companies that are highly correlated with each other. I mentioned turnover. We talk about 20% here. I would say even expect turnover to be closer to 10% or below. We also do limit exposure to emerging markets, the 15%. Today and in the past, the exposure to emerging market has been way, way below that. So has been either at 0 or under 5%. So it's much smaller than what you see here. But if we ever come across an incredibly high quality emerging market business, then we would be interested in investing or looking at it, but it hasn't happened that frequently in the past. On the flip side, selling out of a business happens for 2 reasons and 2 reasons only. The first one is the initial investment thesis on the business is no longer valid. So the reasons we bought this business are no longer attractive to us, either because we just simply made a mistake, which obviously happens, or just because the business over the many years that we've held it changed and the new business or industry or dynamics of the industry are no longer as attractive as they used to be before. The second reason is for selling out of a position is we found out there was a better opportunity outside. And so in this case, we could be selling a business that has nothing wrong with it or no concerns with it, but we happen to come across something that is, in our opinion, more attractive. And again, that happens, the universe is fairly large, and so there's always new opportunities that we discover that we haven't looked at before. Next page, please. One more. Just quickly, this shows you the up and down market capture. So the strategy in the past has performed really well in rising markets. So up market capture means how much we perform when the markets are going up. Down market capture means how well we perform when markets are going down. We, as a team, are a lot more focused on down market capture. Obviously, we think that minimizing capital losses is a significant part of outperforming long term. And we think down market protection is worth a lot more than up market participation, just because simply mathematically downside is exponential. So, for example, losing 50% on the down, you need a lot more than 50% to break even. Now, luckily, in the past, we've actually been able to perform on the up and on the down. I would say going forward, I've always said that, but at this point, clients stopped believing me because the numbers have been different. But we would be more than happy with an upmarket ratio of 100% or even 90, 95%, meaning we perform in line with the market, maybe a little bit less, maybe a little bit more. If we could do that and combine a very strong down market capture, meaning a low number, meaning we don't have as much participation in the down, we would be incredibly happy, which has been the case in the past. And so, but again, if we can do both the up and the down, I would be ecstatic. But expect the strategy to behave in that manner. The strategy is also not one of quick repricing, momentum, risk on. So in a very aggressive rising market, we might lag behind. We would not be chasing anything in the market if the market was to change. We don't invest in highly risky propositions, situations where that are a little bit binary, I would call them. When something good happens, stock goes up significantly, and when something bad happens, stock goes down significantly. We're all about slow and steady compounding, so we're more than happy to slowly compound and expand shareholder creation. And we're incredibly patient and are willing to hold on to a business over longer periods to get the benefit of the compounding. Next page, please. I guess that's it. That's my beautiful picture. I'll stop, I'll pause and take some questions.
Thank you, Nadeem. Are there any questions of Nadeem or Barbara from the members of the board? Can you raise your hand if you have a question? Looks like no questions. Any questions of staff on this item? Anybody else?
Hey, John.
Yes.
Chairman.
Where are you?
Having a really hard time hearing it.
Is that Matt? Is that you, Matt? We're having trouble finding Matt.
It's a little better.
It's a little better. Any chance you can pull the microphones?
You have a question? Are we on? Can we hear you, Matt?
I see Matt on the list here, but he's muted, and he's also logged in through both his phone and his computer. He would have to mute one of them so that we don't hear the echo.
Yeah, so can you hear me? Sorry, guys.
Yeah.
What's our status?
John, you're not coming through that clearly.
Are you there, Matt?
But maybe it's just me. So let's drive on.
So you'll pass? Okay, I think that is the last there, and we'll have to move on to the next presenters then. Thank you very much, Nadeem and Barbara. Wish you well in this COVID era. We'll now,
Thank you very much.
Now switch over to
Thank you.
Addenda Capital. I'd like to ask John Stillo, Senior Portfolio Manager, Core Fixed Income, Christian Robert, Vice President, Investment Solutions and Liability-Driven Investment, and Dan Laverick, Portfolio Manager, Core Fixed Income, to give the presentation from Addenda Capital. Are they with us?
Yes, we're here. This is John Stillo.
Okay, welcome. I'll give my usual little speech. We've bought your services, so you don't have to try to resell us now, and just focus on what you're all about and the portfolio. Go ahead.
Fantastic. Thank you very much. Now, Christian, are you on there, Christian? Sorry, I think we're having a little difficulty here. I'm just going to see if I can. All right, I'm not seeing him. Unfortunately, I will lead then, and if he can rejoin here somehow, I'll let him take over. Thank you very much for having us join today. We're going to recap the investment strategy for the fixed income portfolio that is addressing the sinking fund strategy. If we could advance to the next slide. And sorry again. And one more. We'll start with just a quick recap of markets here, very briefly, knowing that you've probably received other recaps in the recent past. We'll start with the Government of Canada yield curves, as this is a very good synopsis of what's been taking place. Through the course of this year, we've seen some material movements in markets, of course, due to the issues around the pandemic situation and the types of response that we've received. I can hear some feedback. If there's a microphone not muted, could that be turned off? The Government of Canada yield curve experienced a significant decline. You can see where we were a year ago, which was the last time we met with the board, and yields were significantly higher. That was the gray bar, and we were actually experiencing an inverted curve at that point in time, as the market did have some reflection of some concerns around the growth prospects for the economy. And short rates were actually anticipating some form of address by the Bank of Canada. What we received subsequent to that was clearly beyond anyone's expectations, including our own. The situation that unfolded has resulted in the blue curve that you have, or sorry, that you see there, which is the June 30 numbers. And just for a quick reference, today we're relatively around the same levels here. We're not far changed from that. But a significant steepening in the curve, as well as a material drop lower, primarily due to the 150 basis points of stimulus that was added by the Bank of Canada over the last 6 months, most of which was delivered in March of this year. So as a result, that has driven yields materially lower to levels that we haven't seen since late 2016, and we've experienced some very material performance in fixed income assets as a result, given that duration as a risk factor has been compensated greatly due to these types of moves. In addition to and just a quick note here, in addition to the monetary policy stimulus that we've received on the bank rate changes, there has also been some very important developments, and that's on what we would call the extraordinary measures side. The Bank of Canada has stepped up with a number of programs that are large-scale asset purchases, which would be comparable to the quantitative easing measures that the Federal Reserve has put in place, which was post-financial crisis types of measures. We did not have to go there as a country in Canada at that point in time, but subsequently we have now introduced our own measures that include things like provincial bond purchases, as well as a corporate bond purchase program. There is a slide in the appendix that details a number of those measures. I won't go through it, but is there for your reference, that highlights a number of the different programs that are in place right now, all of which are contributing to keeping interest rates at these lower levels. If we could move to the next slide, we can talk a little bit about what's happened on the credit spread front. What we're showing here is the average credit spread of the FTSE Russell Index for the entire corporate bond sector. So just to note, this is blending a number of different rating categories together as an observation of credit spreads. But as you can see, the significant spike up is what took place in March of this year as the economy moved into down on a number of businesses, And of course, the impact is material. We're getting some visibility now and clarity on what that impact has been, and it's certainly on the record books for the largest contraction that the economy has experienced. That's not exclusive to Canada. This is certainly something we're seeing on a global front. Having said that, the market response was a very abrupt move wider in credit spreads on concerns of the impacts on the growth front, but also from a liquidity standpoint. During March, there were a number of markets that were becoming more liquid and very difficult to operate in. And of course, an over-the-counter market like fixed income is certainly one that is subject to those types of movements. And credit spreads did increase materially on the basis of concerns about liquidity and market participation in that category. Subsequent to, we had, as I just mentioned, from the Bank of Canada about corporate bond purchases and the injections of dollars into the short-term funding markets through the purchases of bank commercial paper. There was an unfreezing, and there was some confidence regained in the markets, and you can see we've had quite a material reversal in spreads. We haven't retraced everything, both on the provincial and the corporate credit side. We are still at wider spread levels, but not to the degree that we were at the height of the crisis period. We could. Pardon me, if we could advance to the next slide, please. This is just showing the compositional returns of the bond market in Canada, and you can see the different categories. Just what's notable here is the blue bars. Those are the federal government portions, and you can see that those have been the categories that have been the best performers due to their well, there not being a spread component. So they benefited from all of the reduction in rates. The move lower in yields has driven very strong performance in that category. All sectors have contributed positively or have had positive performance. However, the categories that were spread-oriented, like financials and corporates, are certainly lagging the areas that didn't, and that is just a function of the movement in spreads as previously described. We could move to the next slide. Okay, the next section will be on portfolio characteristics. What we're showing here is the liability discount curve. This is the blended curve that is used to discount or to calculate the present value of the liabilities of the sinking fund portfolio. So this discount curve is composed of a 43% federal government bonds, 43% provincials, and a 14% weighting in corporates bonds. So you can see over the course of the last quarter, we've had a fairly parallel drop in the yield in this discount curve. And that's a function of the movement lower in base rates, as well as the contraction that we've had in the second quarter, or narrowing that we've had in the second quarter on corporate credit spreads and provincial credit spreads. So bringing that discount curve lower through that period. Just for reference, on a year-to-date basis, if you were to see the effects of the first quarter as well added to this, you would see this curve being much steeper than the December 31st curve. And that would be largely because the performance or the movement at the front end is more heavily reflecting the moves by the central bank. So a much steeper curve with lower rates at the front end. If we could move to the next slide, please. Okay, this is highlighting the returns of just because of the distinct differences in both the first and second quarter as far as market activity and economic performance. We've broken up the returns so that you can see the differences in the performance. In the first quarter, we had material underperformance in the portfolio due to the exposure in the portfolio with provincial and corporate credit spreads, and a significant underweight relative to the liability index in the portfolio of federal bonds. The liquidity strains, as I mentioned, were a significant impact. So in the first quarter, we saw provincial and credit spreads out about 50 basis points in the more liquid categories, and similarly, the corporate credit spreads were out about 130 basis points. So as a result, our exposure to higher spread duration resulted in underperformance relative to the benchmark index. We could move to the next slide for the second quarter. We can see something that is much different. We had a very material outperformance during this quarter as the situation with liquidity was alleviated by the central bank's response, and their commitment to the lower rates and their addresses to the liquidity issues of the market propelled rates lower, but as well as credit spreads narrower. And as a result, we were able to recapture some of the underperformance that took place in the first quarter. Having said that, with credit spreads not fully retracing, as I mentioned, we haven't recouped all of that underperformance. If we move to the next slide, we can highlight a little bit of the portfolio positioning and tie together and align the market movements with the performance of the portfolio for the period. In the portfolio characteristics, you'll see, as I mentioned, we are underweight the federal category. So in the chart on the left, you'll see the relative weightings between the portfolio and the index. And we are materially higher on provincial credit as well as corporate credit. And we're relying on these two categories for a number of reasons. Essentially, it's twofold. One is to obviously increase the yield on the portfolio from the extra carry that we receive from owning credit via those two categories. And that is obviously to bring the discount rates potentially of the portfolio in line with those assumed by the sinking fund portfolios, as the sinking fund contributions are assumed to earn a respective rate of return that will bring their value to the repayment amount at maturity and the corresponding debt issue. So when we look at weights, it shows you one picture, but I think what's more important is what you see from the duration contribution chart beside it. And this will give you a better idea of where the risk is positioned. And you can see the contribution to duration is coming very materially from the provincial category. And that is due to the second part of the strategy, which is using strip bonds to gain the interest rate risk exposure that we need to match the aggregate duration of the liabilities, which we're measuring right now at about just under 13 and a half years. So there are two objectives, and one, of course, is funding the disbursements that will come when the debt issues mature, and the other is managing the overall interest rate risk. And so we're using provincial strip bonds in the strategy in order to gain extra interest rate sensitivity, because they all, or most of them, have a higher duration than just nominal bonds. And as a result, that contributes to higher duration contribution, both on an interest rate but also on a spread duration contribution basis. On the corporate side, we do have a higher duration contribution, but not to the extent that we have on the provincial side, because a number of the corporate positions are being employed on the shorter end of the maturity spectrum and are aligned with the repayment. So a large amount of the credit risk that is in the portfolio is in short maturities. If we would like to move to the next slide, we can highlight the overall key rate duration. So this depicts the interest rate sensitivity of the portfolio along specific maturity categories relative to the liabilities. As I mentioned, liabilities are about 13 and a half years. The portfolio as of June 30 was at 13.8. There was a slight reduction in the liability benchmark due to the inclusion of some new liabilities, which were in the 10-year area, which reduced the overall duration of the index. The portfolio was subsequently adjusted, so we are very much in line with the liabilities at this point from an overall duration standpoint. As you look at the key rate durations, there is some highlight here that we do have some curve risk because of the the way we've aligned the strategy, keeping money at the front end, essentially to provide for the upcoming repayments. There are some material amounts of repayments due next year, approximately $200 million from our portion of the portfolio, which is 35% of the sinking fund. So we are keeping funds near term maturities to that liability, and we're gaining the interest rate sensitivity by being further out the curve. And as a result, we do have some curve risk.
Did we lose him? We've lost him? We've lost Addenda? Everything else is fine? There's Matt. There he is. He's there. We okay? Okay. We're trying to reconnect with John. He's near the end of it. Are we up or? Is there anybody else from them on the line? Or can we switch to them? Sorry?
Is there someone else that would be able to give the presentation? Tristan or Dan?
Are they on?
If so, can you please unmute your mic?
You hear me?
Can we hear John now or not? Can you hear us, John?
Okay. I have problems with the communications in the beginning.
We can hear your voice.
Okay. But I can't see the presentation anymore.
We'll put it up. Is that okay?
All right, yes.
Okay. Could you try to...
Sorry, it's not ideal. I had to dial in with the phone, but...
okay. Could we try to speed it up just a little bit also?
Hello? Okay.
Yep.
Right, yes.
I think, sorry, I'm back. I believe I'm back. Okay, if we could move to the next slide, then we can wrap this up very quickly.
Okay.
We had activity in the portfolio largely around duration adjustments, as we did have several new liabilities that have been added to the portfolio or to the liability index over the course of the last several months, which are corresponding to new issues that the city has done in the market. We have reduced some of our spread duration in the corporate credit component as spreads have narrowed from the wider ends of the spectrum. There were also relative value opportunities that we took advantage of that enabled us to reduce some of the energy sector exposure, and we reduced some of our energy sector spread duration as a result, being able to move from 30-year maturities into 10 years at a very minimal give up on the spread, but reduces the spread duration contribution. Additions were made in the infrastructure financial sectors. There were opportunities there. And we do have an outlook that does have some concerns around real estate. And so we did have a very, very modest exposure to a single position of a real estate related issue, and that has been removed from the portfolio. And if we move to the last slide, or sorry, to the second last slide. Just as a highlight, we do know that impact considerations or ESG considerations are important to the investment board. We thought we would highlight the impact exposures that are in the portfolio currently, and if we could go back to the impact positioning slides. You can see the exposures there that are related to climate change, community development, health and wellness. These are a couple of the impact categories that we have defined internally. Roughly right now, about 22% of the portfolio is exposed to what we consider impact positions. A number of that, or a good portion of that, is in renewable energy, and that comes through some of our exposure to Hydro-Quebec through the strip bond area, and the other ones are coming through a number of different issuers in different categories. But we are certainly conscious of this desire for this kind of exposure in the portfolio, and where we can, as they align with the liability characteristics we're trying to meet in the overall strategy, we're continuing to incorporate these types of investments into the portfolio. So I will leave it at this point and hand it back.
Thank you. Do we have any questions of the presenter at this point? If you do, feel free to raise your hand. You'll hopefully come on the screen shortly. Nobody else? I see Mary, I see Sharon, I see Pamela, Heather. Doesn't sound like we have any questions at this point, so thank you, John, and sorry for the technical difficulties, and we'll look forward to seeing you in the future, hopefully post-COVID.
Thank you very much. Thanks so much. It was a pleasure to be here. Thank you.
At this point, we're turning to Fiera Fixed Income. I'd like to ask Benjamin Luck, Vice President, Institutional Markets, Carolyn Grandoy, Vice President, Portfolio Manager, Cross Asset Solutions, and Martin Dion, Assistant Vice President, Liability Driven Investments, to give their presentation. And over to Benjamin, I guess, who's going to be doing the presentation.
Great. Yeah, thank you very much, Chair. So for the record, my name is Benjamin Luck, Vice President of Institutional Markets, joined by Carolyn Grandoy and Tommy Willett of the Fixed Income Solutions team. So if we can flip to page 2, one page over. Just to add on to this slide, Barbara Sheehan covered this already, but we are structured as a multi-strategy boutique firm. So what that means is we do have a number of different strategies, particularly on the fixed income side, that are unique to each other, and we have separate teams that manage that. So flipping over to the next page, that is just useful context for this slide, which is our new Fixed Income Solutions team. We have built upon our traditional LDI capabilities to form this new solutions team, which allows us to take advantage of all the capabilities across those other fixed income teams that I mentioned above and those investment professionals. So as a result of this change, Carolyn Grandoy has been promoted to co-head of the new team along with Tommy Willett, who was also previously a member of the team, but also accrued experience working with some of the other fixed income teams at Fiera over the years. And lastly, as a result of this, the previous head of the LDI team, Stefan John, is no longer with them. So moving on to the next page on slide 4, I just wanted to quickly go through the responsible investing timeline at Fiera. Really, for us, we have started doing this a long time ago, mainly due to our exposure with our religious order clients. But over the years, and most recently, we've established a global corporate social responsibility committee. And also, more recently, we crafted up a new global proxy voting policy and also a responsible investment spectrum. But more specifically, how that relates to fixed income, we can flip to the next slide then. And then at this point, I can pass it on to Carolyn Grandois.
Okay. All right. Well, thank you all. I'm happy to be with you today. It's great. I do look forward to meeting you in person eventually. I was going to go over a few subjects with you today. First of all, the team change, to just quickly talk through that, then talk about ESG integration, both within the team itself and within your portfolio, and then finally do an overview of the Canadian bond market. That being said, as ourselves and your prior manager who's just talked through share clearly a bond market, and they've done a great job going over it, I'm going to shorten that part of the presentation to make sure that we leave ample time for performance. So just quickly introducing myself, you would have seen me in prior team slides. I've been at Fiera LDI for a number of years now, and I've been managing clients. I've been looking at your account from afar as well from the office, although we've not met before. Effectively, as of the month of June, I now have the honor of leading the team into our transformation. The idea is for us to really kind of do what we do better and to be supported by a structure that's more flexible. So effectively, instead of being recognized as a single investment team within the firm, the idea is for us to really push forward what we do, which is building, crafting solutions for clients such as yourselves. With that change, we've brought back to the team Tommy Willett, who is also going to co-lead the team and really focused on everything that's truly pure fixed income solutions, whereas I continue to focus on both fixed income and other asset classes in building together solutions that bring the best outcome for clients. We do not expect any further in the changes in the team. I'll make sure as well to give you time at the end for any questions if you have them on the team changes. Now, moving on to ESG. So ESG at the firm is something that Ben has just touched on. There's a clear path to improvement that Fiera has embarked on, especially when it comes to increasing diversity in the front office. I hope that you're seeing my presence here today kind of shows that effectively this isn't just something that we say. Clearly, Fiera has put in charge a woman in charge of quite a large amount of assets within their front office. We have a number of programs also in place to continue increase the presence of women within our investment function and within other functions at the firm. And we are also lucky in terms of building also things for the future to have within the LDI team one analyst who is also a woman who studied in STEM, who also brings a lot of coding experience, so in a very non-traditional role as well. So that's something that also I will look to continue improving within the team. Now focusing on your portfolio yourself. So ESG is something that we look to for all of the names that you are invested in. So as you know, we very much act with another team at Fiera, our credit research specialists, to build the credit names that are included in your portfolios. And all of your credit names are looked at both in terms of the quality of the company that we're invested on. We're really making sure that we are taking on debt with companies that we believe are going to be able to bring forward their business plans and are going to be able to meet their payment obligations in time. This is especially important for a sinking fund such as yourself, because you very much depend on the payment of the bonds that you're invested in to be able to meet your cash obligations yourselves. In addition to that, as part of our fundamental analysis, we also look through to the companies to make sure that they are sustainable. We truly believe that in order for a company to be profitable in the long term and to be to continue operate in the long term, sustainability is a non-negotiable. So that is something that, as part of our credit analysis, we thoroughly incorporate, and also we use metrics from outside providers such as MSCI ESG to be able to rate the portfolio and to look through it. So these are things that we've always done for your portfolio that we continue doing, and we actually look forward to bring in more information as to the quality of your portfolio in terms of ESG grading, but also in terms of participation to impact and so on. So that completes it for the ESG portion of the portfolio. I'll move forward to the two other pages. If we could, thank you. So the interest rate, you've actually seen this chart like 10 minutes ago, so I won't go over it, but obviously what has just been described by your prior manager also very much is important for the same, we're participating in the same market as, of course. So we've been managing the same outside forces throughout the year and throughout the past quarter. So as you've seen, rates shifting importantly with the Bank of Canada cutting their overnight rate 3 times in the first quarter, going from a rate of about 1.75% at the beginning of year to 0.25% as of after their cuts. So that is a major change in the bond market. Further, with everything that has happened, not only with the COVID response, but also oil truly impacting our Canadian economy, those things has bring quite a bit of upheaval in the credit spread market. That's an important market for you as well. Just as your prior manager mentioned, you are invested in credits into that market. So what we've seen as a response is a huge widening of rates and also a liquidity drought in the market during the month of March. The Bank of Canada acted swiftly. Just as the Fed did in the US, the Bank of Canada decided to put in place their first secondary purchase program in the market to help bring back liquidity. That response from the Bank of Canada, coupled with the fact that investors saw that developed market economies widely were truly stepping in to help help both investors, but also individuals in the market carry through this very difficult period, has brought back some ease into the market. As such, if we move on to the next page, we've seen that where we saw credit spread truly widening, importantly at the beginning of the year, the levels have subsided a bit on those announcements. That being said, we see spread level continue to be elevated at the moment. So I think the most important message to bring out of this is that the market in general has been volatile. It is more important than ever to have fundamental analysis support the credit choices that go into your portfolio. Because although we're seeing this for the market in general, and it's the same thing with the equity market actually, this is not every name in the market is moving this way. Effectively, it is more important than ever to consider that things are behaving differently sector by sector, quality by quality, and name by name as well. So that is where we continue to truly believe that it is important to look at the fundamental of the names to support the investments that we make for you for a few reasons. First of all, to make sure that they remain profitable, that they get you to your investment objective, and more importantly, to make sure that liquidity is there when you do need it to be able to fund the sinking funds activity. In terms of performance, again, your prior manager went over it. Spreads having moved a lot, so have rates in general. Bond market indices have been positive, though, through the beginning of the year. So I'll now pass it on to Martin to go over the performance of your portfolio through the end of May and with a quick update of where things stand as of where we are now in July.
Perfect. You hear me well?
Yes, we can hear you well, Martin.
Okay, so yeah, on the next slide, there is just a recap of our mandate. So obviously the main objectives are to ensure let's say the repayment of the debt that is issued by the city. So there are actually 5 different sinking funds. So we have to ensure that there's sufficient liquidity, that when a payment is due to be repaid, that it's in the account, and that we can sell bonds at the time to make sure the payment is made. The other objective is to match the overall interest rate exposure of the aggregate sinking fund. So to make sure that you're being compensated when the interest rate decreases. So let's say the city issued debt at 3%, and then suddenly the discount rate, the interest rate is decreased to 2%. Then in the future, you would earn only 2% on the bonds you have in the portfolio. But with the strategy you have here, is that you're being compensated with the decrease of interest rate with the actual assets that you have in the portfolio. So maybe just a simple illustration that we prepared just to make sure everybody understands the mandate. So initially we had, in this case, 2 sinking funds. The first one had the payment due in 1 year, and with the assets that were matching the repayment. So you can see here that this one is well funded because the payment is becoming due shortly. The other sinking fund, let's say, had a repayment in 5 years. The assets were at 5 years too, to make sure the repayment. But this one is not funded a lot because the maturity is later in time. So now, if you merge, let's say, both sinking funds, you can see that they have the same repayment value of $50, one at time 1, the other one at time 5. So overall, they have the same weight. So the duration of the liability here is 3 years. Then if you look at the assets that we have without making any changes, the duration of the assets, because there's more allocation to the sinking fund A, sorry. So you can see that the duration of the assets is 1.8 years overall when you combine the assets. So here the mandate is we want the duration of the overall assets to match the duration of the liability. So what we have to do in this case, there's more assets in sinking fund A. So we're taking some of the assets in there and we invest in more liquids, in liquid securities, federal and liquid provincial, in terms, let's say, matching the repayments, and later as well. We have to invest later because we don't want to take all the money in sinking fund A to invest later, because when the payment becomes due in 1 year, we will have to sell these securities and ensure that the city can source the payment from the sinking fund. So basically, that's what we're doing, and that's why you can see that the assets we have to invest in longer term, let's say, than the last liability payment, just to make sure we have sufficient liquidity in the front end, but to match the overall duration in the end. So now on next page. Okay, so the portfolio as of May 31st. So the market value of assets were $536 million. The yield to maturity was 1.78%, slightly higher than the liability, because the liabilities are composed of 43% federal, 43% provincial, and 14% corporate. So we have more exposure to credit, provincial credit, and corporate credit. So it makes the yield to maturity higher than the liability. The duration is slightly lower than the liability. It's 0.34 years at that time. Right now, it's more close to 0.2 years as of June 30th. And again, if we look at the chart on the right, so the evolution of the portfolio and the liability duration, you can see that, in the last quarter of 2019, we're getting very, very close to the liability duration, but then new issues from the city in the long term, they did increase the liability duration. So we're, let's say, quietly moving towards the liability duration. So we invest repayments, we invest coupons in longer term maturity, but also the maturity, the bonds are maturing, we're investing into to increase the duration of the liabilities of the portfolio. And again, because with what we saw with the illustration on the previous page, you can see that the key rate duration, there are some curve risk, as mentioned as well by John, the previous manager. So you can see around 10 and 20 years, we have some differences between the assets and liabilities. And this is the main cause of when we talk about performance, of the underperformance of our portfolio against the benchmark since the beginning of the mandate. And it's because the yields in the term around 10 decrease more than the long-term yield. So it makes that the liabilities perform better because the portfolio is underweight at this point. On the sector allocation, we have 27% federal bonds compared to 43% federal. The corporate 18% compared to 14%, and municipal also 55% compared to 43% provincial. If we look at the corporate credit allocation, we are pretty much aligned with the benchmark. So it's 35% double A, 45% A, and 20% triple B. And you can see that the overall credit allocation, this is a high quality portfolio with most of the bonds in the portfolio being triple A or double A. And also, if, let's say, the next two payments are significant and will be in 2021, more than 200 million, and if we have, let's say, the same conditions as we had in March, we would have no problem, during the crisis, we would have no problem, the city would have no problem sourcing the assets from our sub-account, or from our portfolio, because we have sufficient liquidity. The federal bonds provide liquidity even in the time of the crisis. They were trading quite well. And also, at the beginning of the curve, we have a lot of bonds maturing on that day.
Martin, maybe in the interest of time, we can stop the presentation there and open it up to questions from members of the board. And the usual routine, if you have any questions, please raise your hand. I see some people with their Heather scratching her head, or is she asking a question? No questions? Then I think at this point I'll thank the presenters, and we've had 3 presentations now, and could I have a motion to receive the presentations? Can somebody raise their hand? Heather, all those in favor? And the motion passes. So thank you very much, and we'll move to item number 3. IB 7.3, Sinking Fund Long-Term Fund Performance Compliance Update for 2019 and first quarter of 2020. And we have Randy, recently shaved Randy from west of us here. Can you take over and provide an overview?
Yes, hopefully everybody can hear me out there.
We can't hear you very well, Randy. Can you try again?
Okay, can you hear me now?
That's better. Go ahead. We can't hear you now.
Yeah, can you?
Sorry? Okay, go ahead, Randy.
Okay, this is a 7.3 report for information. It really gives the performance and compliance update for up to the end of 2019 and the first quarter, because we missed the April meeting, kind of a larger than normal report here with there's 17 tables and 4 attachments, but I'll try to simplify it here that it's basically in 3 parts. The first is the earned income that we look after for city budget purposes. The second is the market value or the total return. You've heard some of that information already from the 2 fixed income managers, but there are 2 reports attachments from Aon, and if the chair is okay, I'll defer that part to Aon to present. That's attachment 2A and 2B, 2A being the performance up to the end of 2019, and 2B is the first quarter of 2020, which we know was pretty rough. So, and finally, the third part is the compliance, and that is very easy to talk about, as we were in compliance with the investment. And 1A and 1B address that, and you can see that they're all check marks for staying in line with the policy. As far as going over the earned income, or what, as the report also recalls the book, on page 6 of the report, for the sinking fund, the overall yield in the sinking fund to year end was 4.9%, and the sinking fund earned 83.1 million, which was good. The first quarter, the sinking fund earned 8.6 million, which yielded an annualized return of 2.3%. But again, short-term performance. The other thing I wanted to point out is, since we're on the sinking fund, is on page 7, the flow of funds. You heard Fiera mention that there are no maturities for the sinking fund in 2020, but in 2021 there are 2. Which amount to $650 million. And of course, we'll pull that out of the funds as they come due. There's actually two maturities, a 500 and a 150 million. Just turning to the long-term fund performance, again, I'll move through all of these tables, which I'll let you read, and some of it has to do with market performance, which I'll let from Aon talk about. But as we get forward, there is the earned income requirement, and for the long-term fund, there is a budget for the city, which in 2019 was 108 million, which is equivalent of earning approximately 3.7% on the portfolio net board expenses. It goes through and it talks about the expenses. I'm happy to report that the investment income in long-term fund for 2019 was 187.9 million, and the total income less board expenses exceeded the budget by about $50. So we were ahead of the game. 19. Looking at the first quarter in 2020, again, on 13 was the acquired income for the operating budget for the city is 143 million this year, and so far in the first quarter, the portfolio has earned 31 million. So we're not in bad shape, and hopefully, as things correct as we go along in the quarters, that earned income will rise. We have 112 million to go up that. For up to year end. The flow of funds for the long-term fund, you may recall that last December we mentioned that there was an excess of 500 million that we were going to transfer in April of this year from the short-term fund that we and move it over to the long-term fund. As we explained, that 500 million would for April 2020 was not completed due to the COVID situation. There's excess liquidity, given what was going on at the time. So moving that 500 million over to the, as I mentioned, the very last point in the written report, attachment 1A and 1B, is about the investment policy and plan compliance, which everything is okay on. If there's, at this point, I'd like to turn it over to Brian from Aon, and he could walk you through the Aon reports for on attachment 2A and 2B. If Brian is still there.
Yes, I'm still here, Randy. I'm having a little
Great.
trouble getting my video up and running here. So please tell me,
I
I'm not
can see
sure
you.
whether you can see me or not. So.
Yep, I can see you.
Excellent. Okay, good news. And do we have Nick DeLisi on the line as well? Nick?
I can see he's signed in, but I can't see if he's got his video or anything on.
Yeah. Okay, he's on the line, but he says he can hear us. He is redialing in. But let me start out. First off, Mr. Chair, can you just give us a time frame that you'd like us to adhere to?
As brief as possible. I think we're running a little long here.
Okay, so, okay, in the interest of time, I'm going to turn it over to one of our team members, Nick DeLisi. I think probably we'll focus on the more current information opposed to going back to December. So unless there's questions. So Nick, are you there? Are you there, Nick?
Randy, can you do your Nick imitation if we can't find him?
Hi, Nick's joined. Are you able to hear me?
There we go. Yes, we can hear you.
Okay, great.
So Nick,
sorry, me to go?
Yep, that's okay. Nick, the floor is yours. If we can focus on the more current information, the chair has asked us to be brief.
Okay, great. And so maybe in the context of being brief, I can very much skip over a market update. I'm sure everybody's quite aware with what's been happening within the equity market, so I don't need to repeat that. But if there are any specific questions with what we're seeing, what we're recommending to clients, I'm happy to answer that. But maybe I'll sum up our recommendations over the last 3 months and what we're seeing moving forward and a couple of key themes. And then again, I'm happy to expand on it if anybody has questions. So certainly throughout the market volatility, our main recommendation to clients was to stay within their strategic policy if they had set one. And then certainly, this board has a strategic policy in place that a lot of thought and work and analysis would be put into it. So we were comfortable with the Toronto Investment Board following their policy and really only rebalancing if they were breaching any weights. And we know that the portfolio is in transition, so I don't think that there were any concerns there. For a minor period at the very end of March, the first 3 weeks of April, we believe that relative equity valuations were somewhat attractive, and we were comfortable with clients adding to equities up to policy weights through that point if a lower weight was recognized in the portfolio as a result of poor Q1 performance. But since the end of April, we've been at what I'll call a do nothing stance, which is again stick to your policy, and that's where we really remain today. I think some of the concerns or I'd say caution that we have moving forward is certainly number one, any sort of return of market volatility as the pandemic second wave, or I guess what I consider as continuing of the first wave in the U.S. Comes back and impacts markets. And then certainly any volatility around the U.S. election as rhetoric heats up there, whether it be between the candidates, between what is significant, I'll call it social concerns to the south of the border, and then obviously trade pacts globally. So I'd say a cautious view on potential market volatility for the second half of the year, though certainly the third quarter thus far has been a continuance of what's been a rebound that we've seen in Q2. When we look at Q1 numbers, and I have some updated Q2 numbers for the board, they're not in any of the packages that you might see, but I'll speak to them verbally. So Q1, a bit of a tale of the two worlds for you. Both the sinking fund and the long-term fund are heavily weighted towards Canadian fixed income. So the sinking fund and the long-term fund, as at the end of Q1, were about 87% invested in fixed income, with 13% invested in equities, although that would have been a little bit higher starting in January. So as much as the market volatility did have an impact on the overall portfolios, and certainly significantly on the equity portfolios, the overall portfolio was quite buffered from a lot of the market shocks, given the high level of fixed income investments. So the sinking fund over the first quarter had a negative 2.1% return, which did underperform its long-term benchmark by 2%. And a lot of this just had to do with the equity portfolio performance, particularly as Fiera was funded in mid-February. That's some of the gains in January would not have been realized within that fund. And then also the allocation to the Harris Global Equity or the Oakmark Global Equity Fund, which is a deep value-oriented manager and one that invests in the stocks across the entire capitalization spectrum. And if you look year to date, and particularly in Q1, the value factor and the small cap factor both led the market in underperformance versus a broad-based benchmark. So while we're not thrilled certainly with the performance, and we're not here defending the manager's performance over Q1, it is somewhat explained by overarching market factors. Any managers who may have been geared towards momentum or quality factors, like Fiera, like Sea Worldwide, showed some strong outperformance and downside protection during Q1, and have maybe lagged the market a little bit on the quality side in Q2, but year to date have performed well. Those managers who are more momentum oriented and are maybe playing around in the NASDAQ a little bit have obviously done exceedingly well this year. So the sinking fund, again, at negative 2.1% for the first quarter. You've heard from the LDI managers. If you're looking at page 2 of our reports, page 4 of the PDF, you'll see that there was some significant underperformance from Addenda on the LDI side. Addenda happens to hold quite a bit more credit within its portfolio than Fiera, and credit spreads did increase significantly. Returns on credit were quite negative, almost similar to that of equities from I'd say a magnitude perspective, given its relative asset class. So that underperformance of nearly 6% in Q1 of its LDI benchmark, more than half of that came back in April, and then we've seen a significant rebound from them in Q2 as credit spreads have continued to tighten. So I think the overarching theme for the Toronto Investment Board is, maybe not the exact results that you're looking for in Q1, but the bounce back in Q2, has reversed a lot of what seems like an unfortunate return stream for the portfolio, and I'll touch on that shortly. If we move ahead to page 3 of the document, or page 5 of the PDF, we look at the long-term fund. Similar to the sinking fund, it was negative over the quarter, negative 1.5%, but slightly outperforming its benchmark by 0.1%. CC&L and Leith Wheeler both underperformed their benchmarks. Leith Wheeler more so than CC&L. Both managers underperformed predominantly due to overweight credit allocations versus the benchmark, and Leith Wheeler just happens to have a larger corporate bond allocation than CC&L. So you see a little bit more of that underperformance there. And then the equity managers are the same across both portfolios, so I won't touch on them necessarily there. If we, fast forward, so, I always find that these reports can get dated pretty quickly, and especially given the market rebounds, looking at March 31st numbers is really tough. If we fast forward to a year-to-date performance number, I can focus on the long-term fund because we don't yet have the LDI numbers, just given the nature of the portfolios and the benchmarks. But year-to-date, the long-term fund is up, and I'll say these are preliminary numbers, approximately 6.3% to the positive. So it is underperforming its benchmark a little bit, but there is a positive return on portfolio year to date. That's driven by, again, the significant overweight to fixed income. Leith Wheeler and CCNL have returned 8.2 and 7.3% respectively. So the overall fixed income allocation is slightly outperforming the benchmark over the year to date period. When we look at the equity portfolio, there's an average year-to-date, the average year-to-date return is still skewed quite negative. Harris had a significant rebound over Q2, but remains about negative 16% year-to-date. Fiera with a late inception date and a 9.7% return in Q2 is negative 5.2% year-to-date. And Sea Worldwide, after a strong Q2 of 14.3%, is positive 6.8% year-to-date. So the equity portfolio, again, continues to rebound, although is slightly negative or is negative still. But the overall positioning of the portfolio, again, weighted to bonds, has shown a 6.3% positive return year-to-date. And I should say that the overall portfolio outperformed its benchmark on the long-term fund in Q2. Again, maybe to wrap up, quickly, we continue to be happy with the positioning of the portfolio. We have the 3 equity managers, the satellite managers funded today. The 2 fixed income managers, we continue to have high conviction in, and we were not surprised with their strong performance as they came back in Q2. Again, I think the overall conservatism of the portfolio being heavily weighted to bonds will always provide that buffer versus the significant risk in the equity markets. But we continue to have high conviction in the 3 managers that are employed within each of the long-term and the sinking funds today.
Thanks, Nick. Do we have any questions either for Randy, Brian, or Nick on this item? Any questions or anyone wants to say anything on this item? Okay, could I have a motion to adopt the presentation from someone? Please raise your hand. Pamela, thank you. Do I have all those in favor? Raise your hands if you're in favor. Thank you. Carried. And now we'll move on to IB 7.4, Investment Manager and Investment Plan Update. We do have a staff report with this, with recommendations, and we also have a confidential attachment, and we will later on go into an in-camera session. But at this point, I'll ask Randy to give an overview, a quick overview of this item. Randy?
Thank you, Mr. Chair. And just to give you a bit of a summary of what this report is about, one is to update the investment plan, which basically just adds Fiera Capital Corporation, the manager you heard from the first presentation this morning. They were funded in February, so we have to update the investment plan. The second thing is the confidential attachment that the chair has mentioned, and that has to do with the global equity investment managers that we were negotiating contracts with. And then finally, the third point is that the report recommends the board delegate authority to the chief financial officer and treasurer or designate to approve payment of invoices for services completed for the board. This has become a little bit of an issue as we've had managers, and there's a whole place in Toronto, the city of Toronto, to pay those invoices and purchase orders, and it's quite cumbersome. Our fine people over in accounting services have recommended that if the board would or to pay these directly, we could move a little faster in paying the bills. Along with that recommendation to provide a report annually to the board, the invoices or more frequently as written. So that's really what we have in this report. As you recall, we were negotiating with 2 global equity managers. We signed one in February. There's still work to be done on the final one, and then some of this it goes back to discussions in September of 2019, and what we're looking for is a authority to restart negotiation that global investment manager.
Are you finished with Randy then?
Yes, yeah, that's
Okay, any questions for Randy from any of the members of the board? Well then, we will hold this item before we go into closed session. We'll move to item IB 7.5, real asset update, and we've got a staff report with recommendations and a confidential attachment, and we'll be back to Randy. And when Randy finishes his comments and after any kind of public questions, then we'll move to an in-camera session. Randy?
Right. IB 7.5, our last report, is really another for information report only. It does not recommend any managers at this point, but the reason we brought it forth was really twofold. One was that the decision to start work on the real category November 2018. So it's been almost 18 months, I guess more than 18 months since this was adopted by the board. The second point was to give the board a bit of a background of what the work has been done to date. You may recall that I think it was at the December meeting when we decided to change the overall geographical mandate of one of in the investment policy from Canada on real estate to North American global focus. And so the date of this report was written, we passed that at council. I know there's the new business, which at June 30th did pass. So some of this information was really just to bring the board up to date. There was a lot of pre-screening completed by Aon, which is not included in the confidential report. And to date, we've only had one meeting with their analysts. We have not interviewed or evaluated any of the managers in that confidential report, but it's just to really give you a bit of an update of what we're looking at. And really that is it for this item, Mr. Chair.
Thanks, Randy. Any questions of Randy or any just general comments before we go into closed session? Could I have a propose we go into closed session now to ask the clerk to display a motion to go into closed session, which I will read out as well. Motion is that the Toronto Investment Board receive the public meeting to meet in closed session to consider IB 7.4 investment manager and investment plan update. Reasons for confidential information involves the security of property belonging to the City of Toronto or the Toronto Investment Board, and IB 7.5 real assets update. Reasons for confidential information involves the security of property belonging to the city or one of the agencies or corporations. Could I have all in favor of that? Raise your hands, please. Carried. We'll close the meeting now to members of the public and only provide access to members and appropriate staff for the closed session portion of this meeting. In addition, the live stream will be suspended until the closed session is over. Members and staff, I remind you to arrange your surroundings so that no other person observes any part of the closed session. I'll wait just a moment for the clerk to advise that we're We're all set? The clerk will advise when we are ready. Just been advised by the clerk that we're back in open session. We'll consider publicly each of the items considered in closed session. The first one is IB 7.4, Investment Manager and Investment Plan Updates. Are there any questions of staff on this item? Any questions of any speakers? Do I have a motion to adopt the item from someone? Raise their hand, please. Matt? All in favor? Carried. Next item is IB 7.5, Real Assets Update. Any questions of staff on this item? Any speakers? Do I have a motion to adopt? Mary? Any naysayers? Motion's carried. Now, last item is IB 7.6, Investment Policy Update. I think everybody received a copy from the city clerk's office in terms of what was approved by council in terms of our investment policy changes. And I'm assuming everybody read it. Are there any questions of Randy on this item? Can I have a motion to receive the item? From Pamela, thank you. All in favor, raise your hands. And opposed? Carried. That concludes our first online meeting for today. Thanks, everybody, and the meeting is adjourned. Thank you.